Well, earlier today, the Treasury announced its funding needs for the coming quarter, saying auction sizes are likely to rise in a gradual manner over the medium term. Combine that with interest rates at practically 0%. Are we seeing the potential for a dollar carry trade evolving? Joining us now is the CEO and founder of the biggest foreign exchange-focused hedge fund, John Taylor of FX Concepts. Currently has $9 billion under management. John, we heard a lot of buzz about this in the past few days from traders who said what we saw in Japan with the borrowing of cheap yen, shorting of it, using that to go buy equities, go buy commodities. That trade is now happening here in the U.S. with the U.S. dollar. Are you seeing this?
Yeah, it makes a great deal of sense. I mean, it's tremendously logical. The dollar interest rates are close to zero, as you've said, and the outlook for the dollar is generally negative over the next several years.
Wait, is this new, or has this already been in play for a few months now?
Yeah, I think it's been in play for a few months. Certainly, it's been in play a great deal in the month of July, and so therefore that would make me nervous about, very, very nervous about entering the trade at this moment, because on Monday the sentiment poll showed that only 3% of the country, 3% of the traders were bullish on the dollar, which is a historically low rate.
Well, this trade, isn't it essentially a bet that the Fed won't raise interest rates, or at least not in the near term?
Right, I think so, and that's a very good bet. I don't think the Fed will raise interest rates for several years.
The trade is just too popular right now for you to get involved.
It's extremely popular, so we'll probably have a reversal for a couple of weeks, and then it's probably a great idea. So you have to remember that for a couple of weeks from now.
A couple of weeks. Revisit the concept then. But you really like emerging markets right now.
Yeah.
So that's usually a reflection of an appetite for risk, but then we saw the strong pullback in the real today. Are you away from Brazil, focused elsewhere in the emerging markets?
Well, actually, we're expecting, because of the dollar, this tremendous sentiment against the dollar, we would expect the emerging markets to have a pullback too. For sentiment, for the desire for risk is so high now to go on to risk accepting trades that it's just needs a pause.
It needs a pause. So like today, the pullback that we were seeing in Brazil with the real in reaction to manufacturing data, that's something that you planned for, you called for there.
Right,
you think it's accurate.
and we're seeing it in the NASDAQ too.
Right.
I mean, we actually would call for a top in the stock market. When I heard that I was going to talk this morning, I thought, oh, this is a weird time, because this is a great trade in the longer run. But it's a bad trade in the short run, and it applies even to the equity markets, I think.
Yeah, how much of a reaction are you seeing, or how much of an interaction, I should say, between the currency markets and the equity markets right now? Because just this buzz alone about the dollar trade, you don't normally hear that much talk about currencies when you talk to equity traders like you are right now. Right.
It's historically high. It's never been this high, and we're kind of shocked because if you were to look over a 20-year period, the correlation between the dollar and the equity market is very close to zero. But if you look over the last few months, it comes up around 0.7. If you look, I had a 5-minute chart up this morning. They were almost exactly the same.
Wow.
Yeah.
When you take a look more broadly at the economy, away from the currency market itself, you have said before that you expect us to emerge from recession in about October, I see from my notes here. But you said that months ago.
Right.
Given all the economic data we've gotten since then, where do you believe we are in this?
Yeah, I think it's kind of hard. I would argue that I was wrong and that we have emerged from recession. But remember,
you do think we're out of it?
We emerged from recession in the fourth quarter of 2001, and it took us until, say, the second or third quarter of the second quarter of 2003 before we really felt like we were out of recession. And I think we're going to go through that kind of thing now. We have a year and a half of yuck in front of us, but it's not a recession, right?
Well, we had the chief economist at UniCredit, Roger Kubarch, on this program saying that he now thinks we're in a W-shaped recovery. So we're through maybe the worst on this half, but there's a whole other half to that W to go. When you say we're in recovery, is that a prolonged recovery, or is this a pause before that other half?
Well, maybe his W is right. I don't want to be quite that careful. I mean, it's a yuck. There'll be up quarters and down quarters, I think, during this period. I think basically when we look back at it, if you look at a lot of recessions, they kind of go this way. I mean, starting with the one way back in 1980, where we had a quick recession, and then we had a real rally because the government did some really aggressive things, and then we had another recession. But basically it was 2, but it lasted a long time, and this one's going to last like that too. It's going to be slow to come out. People who are looking for jobs are going to find it difficult for years.
What do you like right now?
What do we like right now? Nothing.
Nothing?
We're kind of negative on everything for a month or so, and then we're going to like it emerging a lot.
Stick with us here on Bloomberg. John Taylor, thank you so much.